Good afternoon. My name is Joe Litchower of Kepler Trust Intelligence, and welcome to our second webinar of this week's theme, Funding Your Retirement. Today, we'll be joined by Julian Kane, a Director and Fund Manager on the UK Equities team at Columbia Threadneedle, and the Lead Portfolio Manager on CT UK Capital and Income Trust. Julian has run the trust for over a quarter of a century and became lead manager in 1997. And he aims to deliver a long-term capital and income growth to investors. And CT UK have recently celebrated its 30th year of consecutively increasing its dividend. Before we pass over to Julian, for those not familiar with our format, he'll be presenting on the trust for around 20-25 minutes, leaving us around 15 minutes or so for Q&A. So if you do have any questions that you'd like me to put to Julian after the presentation, please just pop them in the Q&A box. So with that, it's my pleasure to welcome you, Julian. Please take it away.
Good afternoon. Thank you, Joe, and thank you everyone for joining us today. So just before we cut straight to it, there are a couple of pages in the presentation for those who might be looking later on at the pack, and they cover the normal investment risk warning that shares may go down as well as up. I'm tempted in a UK context to warn that they may go up as well as down. There's also some glossary, covering some of the terms that we'll be looking at today. I'll try and explain as we go through, as well as my biography. So, as Joe kindly mentioned, I've managed CT UK Capital and Income since March of '97. We predominantly invest in UK equities. We ourselves are a UK share. We're looking to invest in the best of British companies and looking to beat inflation with the dividend that we pay our shareholders and to grow our capital, ultimately our share price, ahead of the all-share index as well. As Joe mentioned, we have increased dividends now more than 30 years in a row, and we'll have a look at that in more detail later. We pay our dividends quarterly, pretty much at quarter ends, and that helps a number of our investors with their budgeting. Practical cash flow for those investing to know that those dividends will come through on that regular basis. So as I mentioned, of course, as an investment trust, we are a company in our own right, and our shares are driven by supply and demand for those shares, which is partly driven by the value the portfolio, but of course those can drift apart if they're not considered by the board and the investment managers. And we have a pretty active discount control mechanism by which we aim to make sure that the share price doesn't trade at any material discount to the net asset value. So we will buy back shares when that discount starts to widen. We also, in fact, issue shares a little bit as the share price goes to a premium. So if the share price goes to a premium, say 1.5% over the asset value, then we'll look to try and make sure that that premium is capped, and we will issue shares into that demand. So that way we're trying to balance the share price and keep it as close as we can to the asset value. So turning to page 6, the three main topics that I'll touch on today are, I think, of great relevance to all investors, whatever your horizon by geographic limits or time frame. So hopefully it's got something of value to everybody, but naturally I will focus on the UK, and we'll come and conclude, I think, hopefully, that UK shares at this point really are really looking exceptional value. So cutting straight to it, why does diversification matter? Well, I thought this was perhaps best illustrated by thinking about the fashion trend of the moment, the Magnificent Seven, not the film, but those companies, those large companies that have been driving so much talk and driving the American S&P index to new highs. So there's a theme behind these 7 companies listed at the bottom of the slide. It's partly about AI, but it's also more broadly about technology. And these companies have become so extraordinarily large. The market capitalization of them is in excess of $13 trillion. To put that into context, that's multiples the size of the entire UK equity market. And indeed, one of them, Nvidia, just a week or so ago, its daily price move, just in one day, the price move of Nvidia, in market cap terms, added more than the whole of Shell, which of course is the largest UK company. So just to give you a little bit of context as to how extraordinarily large those companies are. And they make up around 30% or so of the S&P's 500 market cap. So they are incredibly important in determining the direction of that market. And I think that's a level which certainly would concern me if I were investing there, because inevitably the future is uncertain. Technology has been a driving force clearly for the stock market, not just the last year, but arguably over the last couple of decades. But diversification matters. I mean, who could have forecast, for example, that Nokia, one of the great success stories of the late 90s in terms of telephone handsets, would fail almost completely. The rise of Apple was unforeseen. So my broad point is that competition is alive and well, even in tech spaces. Companies can do very well for a while until they're undermined. The internet has clearly drives so much of what we do now, and in the 90s, it was widely perceived that Cisco would be a company selling the routers and the machines on which the internet would be driven. It didn't work out that way, and the share price of Cisco through the early 2000s really had a very rough patch. So when these companies do incredibly well, it's not necessarily a predictor that they will do well in the future, and that's the warning I think that I would leave people with. The very fact that so many of these companies are talked about together, they trade together in trading baskets or exchange traded funds, and therefore there seems to be a self-perpetuating element to their success. They have done well and therefore they will do well. I think that's rather too simplistic. And so when investing money, we always look to have a very diversified basket. And on page 8, I highlight that a little bit, hopefully, by showing just how diverse the income stream is for CT UK by geography. So there are 2 rings to this donut. The outer ring shows where the companies that we invest in are quoted. You can see they're overwhelmingly quoted within the UK. We have a little bit of direct North American exposure and some European as well. The inner ring, though, is rather more important because it shows where those companies actually generate their revenues. So it broadly makes a point, I hope, that although we are investing in UK listed companies, these companies get a lot of their revenue, in fact, the majority of their revenue, from outside of the UK. You can see that North America and Europe combined, in fact, are more important to these companies, the companies we invest in, than the States. So we're very, very diversified by geography, although we are notionally a UK investor. We're also diversified by size, and the next chart tries to plot that. So I've tried to make the case against some large companies, warning that trees don't grow to the sky. The flip side of that is I think there is much more growth potential at the small and medium end of the stock market. And here we look at how CT UK, the portfolio is made up of stocks across the size spectrum. So on the far left of the chart, you can see that the benchmark, which is the lighter blue bar, about 20% of the all-share index is made up of stocks with a market cap of £100 billion plus. So that's the so-called mega caps, oil and HSBC. By contrast, the portfolio has more like 8% of its portfolio invested in those mega caps. When you move to the right side of the chart, you can see the contrast, where we, the dark blue bar portfolio, have over 40% of our portfolio invested in those smaller and medium-sized companies with a market cap of £5 billion or below. So it's not just a philosophical thought that those small and medium-sized companies have more potential to grow. That's rather a truism. It's very much where we see the value at the moment. And as I said at the start, valuations were going to be the second key part of the presentation. There's an old joke that goes along the lines that in theory and practice should be the same, but in practice they're not. So I think we'll just spend a little bit of time trying to unpick what the theory and the practice tell us about valuations within stock markets. So starting with the most obvious example, in theory, a higher starting valuation for a company or a bond will generate a lower return. A bond is most easy to make this example with. So for a bond, when one buys it, you know what the cash flows will be determined out into the future. So clearly, the more you pay for that known cash flow, the lower your returns will be as a percentage. That's clear for a bond, less clear for an equity where one knows the company that you're buying, but clearly the cash flows that come out of that company are unclear. As I described in the benefits of diversification, the future is always unknown, and particularly with an equity. But in general, it does hold that a higher starting valuation for a company will generate a lower return. Now, I should perhaps say that's not always true for individual companies, of course, because going back to that Magnificent Seven, those companies have generated, for the most part, fantastic returns. They're all profitable, and so anyone who bought them long enough ago will have had an incredible return on their money. But what's true for individual companies becomes less true for stock markets. Inevitably, the amalgamation, the combination of lots of different companies mean that size effect, the valuation effect, doesn't hold for markets. So markets tend to be much more driven by valuation than individual companies. Long-term data for this, as shown in the next chart, really is pretty clear. So there are two tables here. On the left, we'll just describe what we're looking at here for the US. So these are charts of starting market valuations. That's plotted on the x-axis, the horizontal axis, and that's plotted against their subsequent performance. So just to go to the right-hand side of that chart, you can see that the market, when it was trading on a PE multiple of around 40 times, subsequently on those two occasions, on one occasion led to a return of 5% per annum, on the other led to a return of about 3%. So this is a chart of multiple decades across a wide variety of economic situations, both forecast, what people were expecting at the time, and outcomes as well. And we've got this scatter chart, which does, as predicted on the previous page, show that if you start and buy the index with a high starting PE, the subsequent return over the next 10 years will be that much lower. So the line of best fit, the purpley line, is designed to give you an approximation using these statistics as to what that curve looks like. And the vertical blue line points to the current rating. So in the US, the current rating is 20 and a bit times as a price earnings multiple. And on that line of best fit, it would suggest you get a return across the next decade, nominal, of about 8% per annum. So in fact, not all that bad, perhaps, but nothing compared to the return that you might get from the UK. So looking at the right-hand chart, you can see that the starting price earnings multiple of the UK market is around 10 times. And if these statistics are right in terms of predictive power, then that would suggest across the next decade we would have a compound growth in that index of about 13% per annum. Now, just to give a little bit of a feel for how that works as a compound number, if you invested £1,000 and you do indeed get 13% compound across the next decade. That £1,000 would turn into £3,400. So it really is a very, very powerful multiplier effect, that the benefits of compound accumulation over time. That broadly sets out the starting position for the UK market. And there's another chart which we can use just to double check these numbers and get a bit more of a sense for the history and how the UK is valued relative to international markets. There's a lot of data on this slide, so I'll just take a moment to try and explain what we're looking at by focusing first on the left-hand vertical, which plots the price earnings multiple for the US S&P 500 index across time. So the grey bar in the middle plots where the price earnings multiple has been about for 50% of the time. So it's been in a range of perhaps 17 times down to about 14 times. 50% of the time the index has traded within that range, and the dot in the middle, the blue dot, shows the median. The wider bars at the top and the bottom give you a wider range, and that shows where that PE multiple has been 80% of time. So only 10% of the time has it been below that lowest bar, and 10% of the time has it been higher. The current valuation, the orange dot, you can see is about 18 times, so it's well in that higher band, which isn't surprising given some of the valuations that have been widely talked about for the Magnificent Seven. By contrast, if you look across the page, the next bar shows the European index, which has historically traded a good deal cheaper than the American market, and the orange dot shows you it's trading below average. But it's when you come to the next two bars for the UK, the FTSE 100 index, that's the largest 100 companies, and then the FTSE 250 index, which are the 250 companies below that largest 100. You can see just how cheap current multiples are for the UK. So we are well outside of that 50% zone. And indeed for the FTSE 250 index, the current valuation, that orange dot, is into that zone where the index is only traded about 10% of the time. So my conclusion from this would be that the UK index, and particularly the FTSE 250, is trading well below its own average and attractively valued relative to international markets as well. Just to go back to the benefits of diversification and caution about how indices are constructed, the bar on the right-hand side shows how the S&P 500 index would look if it were equally weighted. So rather than a market cap weighted index, which has a lot of, which is dominated by the Magnificent Seven, as I said earlier, about 30% of the S&P 500 is made up of those Magnificent Seven stocks. If you equally weight it, same weight for each of the 500 stocks, you can see the American market is actually a little bit undervalued compared to its own history. So outside of those Magnificent Seven, perhaps there is some interesting value in the US, albeit it's much more expensive than the UK market. So why is it that the UK index is trading at such lowly levels? The apathy that surrounds the UK equity market, I think, has been pretty widely discussed now. So there's been a lot of publicity about the lack of investor interest in the UK. It's not just retail investors, but it's also institutional investors. And I think there's a large number of reasons there, which we don't particularly need to go into at the moment. It's just where we are. But it's more interesting perhaps to think, what are the consequences of that, and in particular, what are companies doing about it? And this chart, for me, I think hopefully brings to life some of the dynamics of the UK market at the moment. So the green bars, which are above the x-axis, plot how plot the volume of shares that are issued into the market. So this is mostly new companies listing on the stock exchange, or companies having rights issues perhaps, or placings for acquisitions. And you can see that in most recent years, really post 21, there's been remarkably little issuance in the UK market. So 20 and 21 was a response to COVID, companies rebuilding their finance with rights issues. Since then, since companies have got their balance sheets strong enough and in a robust place, very little issuance has happened and very few new companies have come to the UK market. If you look below the axis, that plots the volume of share buyback. So this is companies buying back their own shares. Now, why would they do this? And the clear answer is that once companies have paid dividends, once companies have invested for their own future, many of them have spare cash, and they recognize that their share prices are at very depressed levels, and they recognize that it's economically sensible to buy back those shares because the return on those shares is so attractive, and that it adds value to their own shareholders. So we are seeing a reasonably unusual period in the UK stock market where the actual market is shrinking. It's not good news from a point of liquidity, but it is a good feature in terms of adding value and recognizing that companies are responding to the fact that share prices are low. So the buybacks really are a response to the fact that retail and institutional investors have been selling shares and leading to low valuations. But in the longer term, we're very confident that the characteristics of profit, cash flow, and dividend drive returns. And the quote from the top by Benjamin Graham hopefully helps to give a bit of a weight to that. Benjamin Graham, known as the Dean of Wall Street, but is actually also well known, of course, as the leading influence on Warren Buffett. It was at Benjamin Graham's knee that Warren Buffett learnt his trade. And the table there hopes statistically to show where the returns could come in future years. So it builds on those charts from earlier. So although the FTSE 100 should give you reasonable returns, these statistically based forecasts suggest the FTSE 250 in small cap should give you even better returns. And as I said earlier, that's very much our conclusion as well from a bottom-up stock picking point of view. And that's where we've focused our portfolio. So to conclude, let me just set out a little bit the dividend history for CT UK. So we have consistently grown our income, which we then pass on to shareholders, from investing in some of the UK's best businesses. And the table there plots our 30 years of dividend growth and just shows how the compounding effect has worked over time. So our first dividend was 3.4 pence a share, and we currently pay 12.15 pence per share, giving dividend growth of over 250% over the last 30 years. And although we haven't beaten the rate of inflation in each and every year, we have beaten it very comprehensively over that longer period. So we've grown by 250%. CPI over that same period is over just over 100%, giving our shareholders 30 years of ahead of inflation dividend increases. And when that's compared to other alternative investments that people could have made right at the start, I think it also helps to bring that into context as well. So the orange line on the page shows the returns, the interest returns that an investor would have got from putting their money into a savings account if that savings account had paid the Bank of England base rate. And obviously you can see the impact of low inflation and low interest rates means that since 2008, 2009, very little new interest has been added to that account just in the last year, which started to have picked up. But it's basically flatlined at a bit over £1,000. If that same investor had put the £1,000 into the all share index, they would have got just over £1,000 as well. The point being there that the FTSE All Share Index has had a couple of periods where dividends have been cut, thinking of the financial crisis, and then through COVID as well. So both of those periods we rode out. We did pay increased dividends to shareholders, but because of the cuts, the all-share index increase isn't in a straight line compared to ours, and has been set back quite a lot. So the £1,000, the mythical £1,000 invested by an investor in day one, would have actually given them back £2,376 in interest in dividends over the period. And of course, that says nothing about the capital. This is just focusing on interest. So that same £1,000, if they bought shares at £1, would now be worth 3,150. So they will have had £5,000 back plus for their £1,000 of investment. So my conclusion then would be to investing for the long term, particularly when you've got valuations as attractive as they are currently, really does make sense. And obviously we're focusing a little bit on what people should be doing with ISAs or pensions, and it seems to me that those long-term focused assets really going into vehicles such as this can provide a very powerful boost to people's wealth over time. So that concludes the presentation, and I'll be very happy to answer any questions that people have.
Thank you, Julian. That's that's great. Thank you for going through that update on the trust. And I think it would be a really good place actually to kick off if we speak a little bit more about the kind of macro side of things. I appreciate your process is bottom up, but it would still nonetheless be good to hear the views that you have, I guess, on the UK economy, and pinpointing perhaps the most impactful things, to your portfolio. And given it's quite topical at the moment, your thoughts on the kind of British ISA and what you think that would mean to both the portfolio and the economy.
Yes, I mean, I almost explicitly didn't mention very much about the economy in the presentation, and it's partly, as you said, because we are bottom-up stock pickers, and of course the economy does have an impact on everything that happens, but we firmly believe that for the majority of companies, certainly of those that we invest in, it's the individual specifics of that company and the specific area in which it invests and sells that will drive its success. So on mass, it would be wrong to ignore the impact of the economy, but actually for individual companies, it's much more important to focus on the individual dynamics. I don't think my view of the UK economy would probably be all that different to most. It seems that we're in a dullish spot at the moment. We seem to be rather stymied. But that really isn't a unique position to the UK. Reading newspapers, one would think that the UK was in a uniquely poor position, but that isn't the case. America is doing pretty well. And as I showed earlier, we have a reasonable exposure to the States. But a lot of continental Europe is struggling in the same way that perhaps the UK is. But I don't think we should focus overly much on that, because looking back through history, there have always been recessions and periods of dull growth, followed by some better periods as well. So we're taking a very long-term view. We're not trying to second guess what's happening in the market. We don't think that level of timing is something that people can really ever achieve with any great consistency. So we'd much rather stay fully invested throughout the period, regardless of how the immediate economy appears. And I think with our diversification, yes, the UK is the largest single country from which our investments gain their revenue, but there's a lot of diversification around. And for some of the companies we're investing in, they are really completely remote from what's happening in the UK. So far as the British ISA goes, personally, it seems to me that the intent is positive. It seems like a good idea. I would question, I think as many have, whether it's really going to move the needle. So the number of people that fully invest their ISAs to get up to that £20,000 limit is very few, and the number of people that have another £5,000 to put into an ISA beyond that will be fewer still. So it's unlikely that it's going to be a wall of money that is going to move markets. It could have some impact cumulatively, maybe over the course of 5-10 years. It could have some sort of impact, but in year one, almost none. It's also out for discussion at the moment, and I wouldn't mind betting that after the discussions are finalised, we'll be very close to an election, at which point we'll be almost certainly faced with a new government, and it won't be top of their priorities. So I suspect the poor Bryza is destined never to see the light of day. I think what could be more important is the suggestion that larger institutions and large managed pension funds should make a disclosure as to their level of interest in UK equities, and disclose not only the level that it is at, but why it is as low as it is. For a combination of legislative, accounting, regulatory reasons, investments by pension funds and institutions in the UK have fallen to very low levels. Now, perhaps you might expect me to be slightly biased about this, but they're low compared to international peers as well. So most countries have a natural bias to investing in their own companies. And that is no longer the case in the UK. I think best disclosure is reckoned to come from the Australian superannuation scheme, and they very much encourage investment in Australian companies, and that is seen as being not just patriotic, but a sensible thing to do. So I think the direction of regulation and investigation for institutions and pension funds will have a much larger impact than the British ISA.
Okay, brilliant. No, thank you, Julian. And I guess kind of following on a similar vein then, aside from those points you've mentioned, what else do you see being a kind of catalyst, I guess, for positive momentum behind UK equities, leading them to re-rate, and perhaps why you think the negativity is persisting currently?
Well, it is the most often asked question, and completely fully understood as to why people would want to know when is it going to change. I think at a technical level, of course, once retail investors or institutional investors have nothing left in UK equities and they can't sell anymore, so we're much closer to that than we used to be, and so the direction of travel there is much more likely to be positive, whether it's a British ISA or what. But that in itself would be a catalyst, but it wouldn't be necessarily an obvious one that people would be able to see before the event. To me, though, it comes back to valuation. So if the valuation is attractive enough, then that is a necessary ingredient. It might not be the catalyst, but it's the necessary ingredient. So the chart that I showed earlier with all those scatter points going back over decades, that said nothing about catalysts. It said nothing about what interest rates or inflation were at a particular moment, a point in time. But nonetheless, there is a line of best fit with variations around it, of course, that suggests that when valuations are as low as they are, then statistically speaking, returns have been high subsequently. Now, we don't know from this point what is going to drive those beyond that low valuation. So I think valuation is the most important part. And I think if one thinks of catalysts in terms of individual stocks, then it's possible to see how dangerous it can be to wait for that. So a company can be trading at a very low valuation. One morning at 7 o'clock, there could be an announcement on the screen saying it's about to be taken over at a 40% premium. That's the catalyst. if you weren't invested in it before the catalyst, it's too late. So on all that theme, it is noticeable that a number of companies, a growing number of companies in the UK have received takeover approaches. Some of them have had multiple takeover approaches, either from their peers, competitors, or from private equity. So other people are recognizing that valuations are very low. And as I showed earlier with that slide about share buybacks, companies themselves are aware and sometimes concerned that their share prices are very depressed. So I can't hand on heart point to individual catalysts, not until it's too late. But I think for me, it's the valuation that really matters.
Okay, and on the valuation point, it's discussed so frequently, given its attractive historically, like you showed in your graphs earlier, but also against international peers. It'd be really good, Julian, if you could go through some areas that you're seeing opportunity currently, and perhaps run through for our listeners some notable changes to the portfolio, the underlying portfolio this year.
Yes, certainly. So the largest companies within the portfolio, I haven't, in fact, changed a great deal. I think they are perhaps listed in the appendix. Yeah, so if we're able to go to slide 20. One back, there we go. So this sets out the largest over and underweights in companies as they were at the start of the year. So I'm going to obviously have to put my hands up in a very obvious way that the largest position at the start of the year was One Savings Bank. And for people who've been following, you'll have noticed that they had a very poor trading update, together with actually quite a good set of results just last week, which sent the share price down quite a lot. Now, here I'm going to talk about the benefits of diversification again, because although it's my largest company and it took quite a kicking as a result of those that trading update, in fact the portfolio has continued to perform well. So yes, it's a large position. Yes, I wish it had done better, and we are investigating, but it hasn't in fact impacted performance all that much. It seems very much a case of this year's performance as well. So when we look further out, the numbers for 24 are having about a 10% downgrade, but 25 and 26 aren't being downgraded. So to the extent that valuations for companies should be driven by long-term cash flows and dividends, then actually the longer-term story for One Savings is still pretty robust, I think. So we're not particularly looking to change that. Vistry has performed very well. So it's a house builder, which is really very much focused on provision of partnership housing. This is for housing associations, for local governments and groups like that. So they're typically pre-sold rather than as a traditional house builder would, to build a house and then sell it. So a lot of these are pre-sold to existing buyers, which means it has much less capital employed. Its return on capital are very high, and it should become much more efficient because it has a much more predictable flow of building across the years. So for example, it's one of the leaders in modern methods of construction. They're able to build a lot of the house on a wooden frame inside and then ship it to the building site, and it's a much more efficient way of working than actually getting lots of people to struggle around a muddy field. And Intermediate Capital now, in fact, is our biggest holding, so it's performed very strongly. So there's an awful lot of companies here which have performed very strongly. More recently, we've added a little bit of exposure to WPP, a company that people may know. It's been around for a very long time. Was built really pretty aggressively and successfully at the time through various acquisitions, numerous acquisitions. and it's now at a stage of trying to rationalize and simplify the business. Last year, in fact, the share price was hit because it had a lot of exposure to tech companies, so it does a lot of the media and advertising for Microsoft, amongst others. And that was seen as being a bad thing because a number of the tech companies switched off their advertising in the short term in order to focus that cash on generating AI. But we firmly believe that that will switch at some stage, and having a lot of tech exposure will be seen as being a good thing. Meanwhile, it's trading on a price earnings multiple of less than 10 and an attractive dividend yield. So it's gone from being a hero of the stock market many years ago to being sort of thrown out as an afterthought. Pearson has been a reasonably new investment that's starting to perform well. We've got a new chief executive who's hopefully going to build on the previous chief executive's business. Education really is very much what they're doing. And again, mostly through tech. They had a lot of old textbook business, which inevitably is somewhat in decline. But as they move all the testing and teaching material online, it should become a higher margin, yet a very attractive business. On the downside, on the underweights, we haven't changed any of those positions. So Reckitt, we benefited from. Obviously, we had no way of knowing the very sad story with the baby milk, the American law case, which is under appeal, but that drove the share price of Reckitt down substantially last week. We don't have that. London Stock Exchange, I think, is very interesting, possibly just a little bit expensive for us. We're pretty skeptical on valuation of some of the mining companies, hence why we don't have Glencore. Shell, valuation there is not unattractive. I mean, we do hold some, but the oil sector is inevitably driven by the oil price, and it's almost impossible to call what the oil price will do. So we're generally a bit on the sidelines with the oil stocks. We'd rather take the money and invest in companies which are much more in control of their own destiny. And HSBC, well, the share price there has performed very well. I'm slightly at an arguably superficial level worried that a company where it has enormous exposure to China, I do have question marks about how they're able to contain that. I mean, the front pages of today's newspapers were not being complimentary to China and China's attempts to interfere in UK politics and elsewhere are clearly pretty unwelcome. So I would have that as a note of caution. But in terms of stock selling, we haven't really reduced all that much. I mean, we are really investing for the long term and change the portfolio relatively little.
Brilliant. No, thank you, Julian. That's a good mix of stocks covered there, I think. And I'm going to throw a two-parter at you. I think it's very relevant. So there's a lot of talk, obviously, about the Mag 7. You've gone over that in part of the presentation. But because there's so much kind of dialogue around this, there also seems to be quite a bit of dialogue now around the granola stocks. I know a couple of which you're invested in. So it'd be really good to get your kind of thoughts on them versus the 7 in a way, but also the second part of the question being on the overseas limit. I know obviously you've spoken quite a lot about UK stocks deriving a lot of revenues overseas, but obviously there's a limit for the UK trust to invest overseas for stocks that you can't quite find in the UK. So it'd be good to get your view on why you don't use more of the oversized limit and kind of stick with the European name Heineken as the sole contender.
Yes, it's amazing the ability of stockbrokers to come up with acronyms to try and fit. So I think European stockbrokers were concerned that they were being left behind by the Magnificent Seven, and they had to come up with something to try and rival it. there's nothing, as far as I'm aware, that people have tried to badge onto the UK. So yes, granola would just refer to a handful of European stocks. I mean, we are concerned much more with what individual companies are doing rather than whether they're part of any broader basket or theme. And to the extent that we hold anything that might get lumped into some acronym, it's not because it was in an acronym, it's because we wanted to invest in the individual company. But all of those acronyms inevitably are driven by companies where valuations are much higher than average and where performance has been strong in the past, which is not to say we don't and we want to hold those. And Relex would be an example where, in fact, we haven't held a company all that long, but it has done incredibly well. It has a strong driver through artificial intelligence. It uses that in a lot of the databases that it runs, and where it tries to add value in the services it provides for lawyers, amongst others. So there are plenty of companies benefiting from some of these themes which don't get swept up in the acronyms. In terms of the overseas limit, we are restricted formally to 10% outside of the UK. I mean, that number could be changed if the board wanted to. Where we are currently is largely, perhaps with the exception of Heineken, is largely that it's used for companies where they currently have or have had a UK quote but have gone on somewhere else. So the two examples that spring to mind are CRH. When we first bought it, it was just listed in Ireland. It then moved the main list to the UK, and it's now moving its list to the US. So throughout these three domiciles, it's the same company. We think it's pretty attractive. It's done very well. Where it's listed is largely irrelevant. Ferguson would also be an example. It used to own the Plumbers Merchant Wolseley in the UK, and then it bought an American business. And the American business now is by far the largest part of it. And it's driven incredible value for the business, and the quote has always moving from the UK across to the States to reflect the fact that it's really now an American business and the UK bit's been cut. But we think because it's so attractive and because we know it well, we're happy to keep that position running. We're not aiming to be a global best of breed share picker. That hasn't been our remit. Maybe in future it would change, but we think there are enough opportunities in the UK to be able to create substantial value. And I suppose just to finish on that, of course, the UK market is unusual, relatively unusual in that it has an attractive dividend yield. So for those investors that want a reasonable yield, our dividend yield is about 4, with the prospect of growth, then the UK market is a natural home for that. If we were to change our focus to become much more global, then almost inevitably we would have to cut the dividend.
Brilliant, Julian. Thank you for that. That's very, very clear. And I think just got time for one more question before I wrap up, and it's on the topic of gearing. I think that'll be an interesting one. Having spoken with you before about the kind of levels of gearing you employ, it's a modest amount, anywhere between 4 and 8%, and you're currently at the higher end of that. But perhaps you could just delve in briefly for our listeners as to why it's a kind of modest amount of those figures, and perhaps your views on the current cost of borrowing and the impact that might be having.
from investing in the market. And the bank doesn't like us revealing what it costs to borrow, but it wouldn't surprise people to know that it's closely linked to base rates. So clearly the cost of borrowing has gone up quite significantly over the last couple of years, but the prospect is that it will come down. So we're then left to consider where the opportunities might be, and although I wouldn't want to link it explicitly, if you look at the earlier charts, if those indicators are anything right, like right, then borrowing at 6 or 7 and in getting a return of 13% on the other side would be very attractive. So that's at a large macro level where we are. Of course, it boils down to individual stocks for us as well. So if we found a company that we really liked and we couldn't find anything that we wanted to sell, then we might increase leverage to take it on board. So it really is at an individual stock level, but with that sort of top-down common sense check. At the moment, it drives an outcome where gearing is about 7% or so. To me, that seems in the right ballpark, really. I think one could make a case for being much more aggressive with gearing, but I think we all have to be aware that the geopolitical situation is not perhaps all that conducive. There's obviously trouble in the Middle East, Russia, Ukraine, who knows about China and Taiwan. Any of those could be sort of escalate further, and that would have a negative impact on stock markets. So it's also true that you never want to have so much gearing that you then end up being a forced seller, and we would never want to be in that position. So to have a moderate level of gearing, which adds a bit of extra return in the good times, seems sort of a reasonable position. We're trying to add value through stock picking, not through gearing.
Brilliant. No, that makes sense, Julian, and it's very clear. Thank you for going over that. And I think that kind of brings us to the end of our time for the webinar. So yeah, just firstly, a big thank you to you, Julian, for joining. It's been great to have you on the webinar, providing your kind of views on the UK. It's been fantastic.
Pleasure. Thank you very much, Jeff.
And for those listeners that want any further information on CT UK, then the team published some really quality information on their website. And we at Kepler have also published a full research note in January on our website, so feel free to check that out. For those that dialed in this afternoon, just a big thank you to you as well. I hope that you have a great weekend when it comes. And just to kind of broaden out the week's events to come, tomorrow is our last webinar of the week and of our March ISA event. And we'll be getting an update from the managers of Greenie, Code UK Wind tomorrow. Thanks again to everyone who's dialed in. See you next time.
Thank you.